$78,000. Look, that's not just some random price tag floating on a screen today. As of right now, April 30th, 2026, 78K is Bitcoin's true market mean resistance. To put it simply, it's the historical average cost basis for investors across the entire network. It's basically this invisible line in the sand where buyers and sellers are just locked in a stubborn stalemate. And right now, the market is absolutely exhausted trying to punch through it. That easy, euphoric momentum we had earlier this year is completely gone, and we really need to understand why.
Welcome to today's explainer. What we're witnessing right now is a definitive, massive pivot in how digital assets actually operate. That wild, retail-driven speculative hype from past cycles, yeah, that's officially fading out. We are stepping into a strict, unforgiving, and honestly way more sophisticated era. This new landscape is all about institutional mechanics, hard geopolitical deadlines, and intense regulatory realities. The game is totally changed, and the rules are being rewritten in real time. So if you're wondering what this all means for your portfolio, you are in the perfect place.
Okay, let's dive right into this. Here's our roadmap for today. 1. The 78K macro ceiling. 2. Geopolitics and prediction markets. 3. The institutional yield shift. 4. The Clarity Act countdown. And 5. AI threats and hardware solutions.
Section 1. The 78K macro ceiling.
So, right after the April Fed meeting wrapped up, we slammed headfirst into what analysts are calling the Fed ceiling. Markets were so eager for some relief, in fact, UBS had projected a 50 basis point rate cut. But the Fed, they just didn't deliver. Instead, we got hold signals, which were heavily hinted at by Governor Williams as he actively downplayed inflation risks. Now, why does this matter to us? Well, higher interest rates mean institutional investors can grab great returns from safer, traditional yield-bearing assets. They don't need to take big crypto risks to make a profit right now. So without that decisive signal for cheaper money, Bitcoin is just left completely range-bound. Those macroeconomic tailwinds are totally gone.
But here's where it gets wild. Underneath that $78,000 ceiling, there's this massive, silent rotation happening. We're seeing intense capitulation from miners who are currently operating at a loss. They've dumped a staggering 32,000 Bitcoin in just the last 3 months alone. But wait, that huge sell pressure isn't crashing the market. Why? Because it's being completely swallowed up by institutional income seekers. Traditional finance giants like Charles Schwab and Morgan Stanley are rolling out direct trading, and ETF inflows are just surging. So those speculative retail weak hands are literally handing their assets straight over to sticky traditional finance capital. The entire buyer profile is shifting right before our eyes.
Section 2. Geopolitics and prediction markets.
Let's move to how this builds into the high-stakes deadlines expiring literally today. Today is a huge day for decentralized prediction markets, which, by the way, have rapidly become the absolute pulse of global sentiment. We're tracking 2 major contracts expiring today. First, traders wagered big on the privacy coin Zcash hitting $420 in April. Now, ZEC did stage a nice recovery to the $326 level, but with the deadline here right now, we are seeing intense volatility as traders frantically close out positions. But the second contract, that one's even more critical to the macro picture. The question is, will average daily ship transits through the Strait of Hormuz return to above 15 before May? This is huge because the strait is a massive bottleneck for global oil. If shipping halts, oil spikes, inflation rises, and the environment gets much worse for risk assets like Bitcoin.
Well, it looks like the answer is yes. Polymarket odds just spiked to a 73% confidence level that Hormuz traffic will normalize by the end of next month. With Iran declaring the strait completely open for the rest of the ceasefire, something really significant is happening. We're seeing the rapid deflation of the geopolitical war premium. Think of it this way. When global war fears shoot up, people panic buy alternative stores of value like Bitcoin, artificially pumping the price. When peace resumes, that artificial bump just deflates. The market is forcefully pricing in a return to normal global trade routes right now, which is pulling away that temporary fear-based support.
Section 3. The institutional yield shift.
Now this right here brilliantly illustrates exactly how Wall Street is taming crypto. We're calling it the yield rebranding. Big players like the Goldman Sachs Bitcoin Fund and MicroStrategy are running a brand new playbook. Step 1, they target financial advisors instead of retail day traders. Step 2, they overwrite up to 100% of their Bitcoin exposure using covered calls. To break that down, a covered call just means selling the right for someone else to buy your Bitcoin at a higher price later, which hands you instant cash today. And step 3, generate an actual yield from that cash. By doing this, they're successfully mutating Bitcoin from a super volatile speculative asset into a stable dividend-paying income product. And you know what? That kind of capital doesn't panic sell on a 5% drop. It's sticky, structural, and it is definitely here to stay.
Section 4. The Clarity Act Countdown.
So, the crucial point we need to focus on is this number right here, 2. As in just 2 weeks, industry insiders are sounding the alarm that there is a strict 2-week legislative window left to pass the Clarity Act. If the Senate Banking Committee doesn't push this forward immediately, political gridlock ahead of the midterms is going to freeze this incredibly important market structure bill. I mean, think about the stakes. If this window slams shut, the entire U.S. crypto industry gets stuck in regulatory limbo, suffocating institutional innovation and capital until potentially 2030. That's 4 agonizing years of doing absolutely nothing.
And this brilliantly illustrates why the pressure behind the scenes is off the charts right now. Ripple CEO Brad Garlinghouse is publicly saying we are closer than ever and that right now is the moment to act. You've got the White House, Treasury, and the SEC actively lobbying the Senate. But there's a massive sticking point: regulatory red lines over stablecoin yield. Lawmakers are absolutely terrified that stablecoins might start acting like unregulated bank accounts paying high interest, totally bypassing traditional banking rules. They are fighting bitterly over the final text as we speak. The whole market is just holding its breath to see if we get through this window or get left in the dark.
But you know, while politicians endlessly debate the rules, the technology itself is facing an unprecedented stress test. We really have to ask ourselves, what happens when advanced frontier AI is actively weaponized against digital asset custody?
Section 5. AI Threats and Hardware Solutions.
Okay, so there is some very real anxiety out there right now thanks to severe security alerts from Anthropic's Mythos AI model. This frontier AI actually identified highly advanced, totally unknown firmware exploits that could silently drain digital wallets. Think about how crazy that is for a second. The U.S. Treasury and the Federal Reserve literally held emergency cyber risk meetings specifically about these crypto wallet vulnerabilities. They are taking this incredibly seriously. And to make matters worse, this digital threat is happening right alongside a scary rise in physical violence, these so-called wrench attacks, where crypto holders are being targeted in person across Europe. Thankfully, the industry's defense mechanism is activating today to counter exactly this. Satochip just officially launched its U.S. rollout. And look, this isn't just another product drop, it's a strategic countermeasure. By offering a fully open-source hardware wallet architecture, they're giving people a transparent, non-custodial solution. And remember, non-custodial simply means you and only you hold the keys to your assets, not some bank and not an exchange that could get hacked. This specific architecture is designed directly to resist the exact firmware exploits that the Mythos AI found. Security isn't just an afterthought anymore. It's driving massive, immediate demand.
Bottom line, preparing for May.
Now, what's really interesting about this roadmap is how it brings all these moving parts into a clear, actionable takeaway. Look, the market is obviously exhausted at 78K. Today, the system absolutely has to digest those volatile Zcash and Hormuz contract expirations without setting off a massive sell-off. The immediate, short-term goal, just hold $74,000, is a hard structural support floor. If we can hold that line, and I know it's a huge if, the Clarity Act actually sees positive movement in the Senate vis-a-vis before that 2-week window closes, then the stage is completely set. Analysts are projecting that clearing these specific hurdles could trigger an explosive push toward the $85,000 level in early May.
We are literally watching the DNA of this asset class mutate in real time. Those wild, retail-driven price swings we all remember, they are actively being overwritten by Wall Street's covered calls and sticky dividend strategies. Which leaves us with one final thought to chew on. As this silent rotation continues, are we witnessing the permanent death of the crypto hype cycle, replaced forever by the calculated precision of institutional yield? Thank you so much for joining us on this explainer. We'll see you next time.